Good morning, all. Monday, February 3rd, 2025. I'm Herb Morgan, Senior Managing Director and Chief Investment Officer at Cantor Fitzgerald Managed ETF Portfolios. This is my weekly economic and market commentary. Remember, if there's something to say intro week, and there probably will be this week, given all that's going on with international trade concerns, you can find me on LinkedIn, Herb Morgan, or on X at Herb W. Morgan. The presentation you're seeing and you're hearing is designed by me. It is designed to be used by you, even if you are, regardless of whether you are a financial advisor or an individual investor. Either way, you're expected to make your own investment decisions. Nothing contained in the presentation should be treated as investment advice, tax advice, or the recommendation for purchase or sale of any securities. The views expressed herein are mine and mine alone and may not represent or reflect the views of CFIA's parent affiliates or other portfolio managers here at the firm. Well, as President Trump got into his, third week in office, moving forward on promises related to trade and tariffs, and more specifically related to illegal immigration and the illegal importation of dangerous substances, most particularly fentanyl. He's decided to slap some tariffs. So we're going to get into that in a minute, but that caused markets to go down a little bit last week. You can see here, S&P was down about 1%, mid-cap the same, small cap did a little better. International markets actually performed better on that, but I think over the weekend, the risk-off situation hit everything, all the way down to crypto. Crypto really took it hard over the weekend. Bonds, though, catch a bid. Typically when that happens, when you have a sell-off in equities, and this was just an incredibly minor sell-off in equities, you'll have fixed income catch a bid, and that's what happened. Yield in the 10-year came down, the aggregate bond index up about 0.4%, and the longer-dated 20-plus year Treasury index up almost double that, about 80 basis points. Now, it's interesting. The Fed started cutting interest rates back in September. First interest rate cut. They wanted to get ahead of softness in the labor market, which has never materialized, either because they started cutting rates. I don't think that's the reason, or it just never materialized. And so by trying to get ahead of softness in the labor market, we found themselves behind the curve as it comes to inflation, as inflation has remained stubbornly high. That has had an impact on the residential real estate market, on volume, on prices, and all the people and all the trades that work around the housing market. This graph here shows the orange line is the target Fed funds rate. As you can see, cut once, well, really two, because it was 50 basis points the first time, 3-4 times, or 4 cuts, or 100 basis points. And then I superimposed the bank rate average 30-year mortgage rate, which right when the Fed started, you can see it right here. This is when the Fed started cutting rates. Mortgage rates have gone steadily higher from about 660, got up to about 730-ish, 7.25, 735 down there, and now back just below 7%, but clearly an upward trajectory while the Fed is cutting rates. This is no doubt because the market is pricing in higher inflation for longer. The Fed's just not getting what they had hoped to get. And how is that impacting residential real estate markets? New home sales in December, surprisingly, were up 3.5%. That was more than double the 1.7 expectation, and they're 2.5% higher than they were a year ago. People are finding alternative methods of financing. They're beginning to just accept the higher rates. Maybe the higher rates are translating into a little bit more moderation in some markets and some prices. Either way, new home sales have picked up a little bit. Pending home sales, however, in December dropped 5.5%. That was a sizable drop, but it's not an unusual one. You look across the graph here. Many times you see this volatility in this, and they are down 2.9% from a year ago. And a year ago, we were already in the throes of it, and housing sales have been low now for several years. In terms of prices, we got both S&P Case-Shiller and FHFA prices for November last week. November FHFA house price index was up 0.3, right along with expectations. And they say the average home in the U.S., by their metric, up about 4% on a year-over-year basis. A little bit ahead of inflation. If you think of inflation at around, just under 3, let's say. And then, of course, you add in the impact of leverage, did okay owning residential real estate in the last year. S&P Case-Shiller, they said that in November, home prices were up 0.4%, and a very similar gain on a year-over-year basis, a little over 4%. We then moved on and got durable goods orders for December, and there was kind of a surprise here. The expectations were for a 0.6 increase, but it was a sizable drawdown here, 2.2%. And you can see back-to-back months, you don't get a lot. They happen. There's some there. There's them there. There's obviously the shutdown of COVID and so forth. But you do get these. Nothing to worry about yet because it was a big drop in aircraft orders following a huge gain in aircraft the prior month. So we don't worry about that too much. We don't we don't put anything into that. Then we got consumer confidence as put out by the Conference Board. This week we'll get Michigan sentiment or confidence, University of Michigan. But in January, consumer confidence. Now this is obviously post-election, fell a little bit from 109.5 to 104.1, and it was below expectation. Present situation component fell, expectations fell as well. I think most of this has to do with continued sticky consumer prices. But jobs market remains strong, even ebullient. Weekly jobs claims down all the way to 207 last week, well below the 225 estimate. Continuing claims down below that 1.9 million, 1.858 million. I say all the time, anything below 300, healthy labor market. Anything down at the low 200 is a very strong labor market in the United States. We got a GDP figure for the fourth quarter, not a final figure, a preliminary. In the fourth quarter, GDP, gross domestic product, grew at an annualized pace of 2.3%, less than the 3.1% growth in the third quarter, and a little bit below the expectations. Inventories got dragged down a little bit, as did business spending. Largely, though, this was due to the Boeing strike. That is seen as a transitory event, not likely to repeat. Personal consumption up strong because jobs are plentiful and the consumer remains very, very strong. GDP grew at 2.8% in all of 2024, and the last 2 years are in that range as well. Strong, happy to have it. Personal income and spending, December personal income up 0.4%, personal spending up 0.7. Nothing to see here other than a healthy, strong U.S. consumer. On to more critical data, PCE inflation. PCE, personal consumption expenditure inflation, is the measurement the Federal Reserve Board uses to both measure inflation and to determine whether or not it is meeting its statutory mandate of price stability, which they have self-defined as 2% core PCE inflation. That's the red line. Well, the red line, of course, we know was going up. They started hiking rates, doing some other things like the balance sheet runoff, and then they started cutting rates right around in here. And as you can see, core PCE inflation has not come down at all. In fact, you could even argue that regular non-core has started to spike higher, and that may well drag core up with it, which is what it's prone to do. In December, PCE was up 0.3 in line with expectations. The core up 0.2 in line with expectations. Core is 2.8 year over year. Headline is 2.6 year over year. This is really a problem. This is a problem for the Federal Reserve. And it's a problem for the Congress, but the Congress seems to always want to punt it to the Federal Reserve. Right now, the Fed they have a lot of tools, but mainly they have the Fed funds rate and the balance sheet. But they can't control deficit finance fiscal spending, budget deficits of 7%, which are highly, highly inflationary. Then you add to all of that the talk that came in over the weekend of, you know it because you've been hearing it all weekend, it's tariff time. So tomorrow, Tuesday, will be Tariff Tuesday. But on Saturday, the president issued 3 executive orders to impose new tariffs on imports from Canada, Mexico, and China. These will take effect tomorrow on Tariff Tuesday, February 4th. These are in addition to any other duties, fees, exactions, and charges applicable to these imports. So for Canada, accepting energy will have a 10% tariff. It'll be 25% literally across the board on everything. It'll be 25% on Mexico on everything. and it'll be 10% additional on China, on everything. Now, it's interesting because there was probably 10 million pages of news that one could read over the weekend, right? We could go to our favorite news websites, blogs, television stations, etc. And all of them are simply taking the statement put out by the White House, put on the website of the White House. So I said, why don't I just read that instead? The president feels, according to the statement, that there is an extraordinary threat posed by illegal aliens and drugs, including deadly fentanyl. That's a quote from the statement. So it is partly about trade deficit, but it's not. This president was never particularly good and strong on messaging, and I think part of that is intentional. But in this case, they were very clear. A little bit about the trade deficit, but mostly about illegal immigration, drugs, and fentanyl. And he wants our trading partners to attempt to assist in taking care of these problems. And he says this is an attempt to hold all three nations accountable for their prior promises of helping to halt illegal immigration and the illegal importation of poisonous fentanyl and other drugs. And some quotes. Chinese officials have failed to take the actions necessary to stem the flow of precursor chemicals to known criminal cartels and shut down money laundering by transnational criminal organizations. Mexican drug trafficking organizations have an intolerable alliance with the government. That's a very strong statement. And the government has really done nothing to stop them. And now he says there is a growing presence of these cartels operating fentanyl and nitazene synthesis labs in Canada. All of this is designed to bring these substances into the United States. It's clear that hundreds of thousands of Americans have been killed by these drugs. And so I think the president and the White House looks at it and says, well, trade is important for the United States. It's a significant portion of GDP, but nowhere near 67% for Canada, 73% for Mexico, and 37% for China. If he can get those other governments to put the resources of their law enforcement agencies on these dangerous criminal organizations, and he will use the threat of damaging their economy, and he will use that threat to get them to work towards his goals and to help the U.S. stop the flow of illegal drugs and illegal people into the country. So what was the response to that? Canada immediately announced new tariffs on just $30 billion worth of U.S. goods, including orange juice, peanut butter, wine, spirits, beer, coffee, appliances, motorcycles, etc., and intends to impose on an additional list of goods worth $125 billion. So a tariff on $30 billion, if it's 10%, it's $3 billion. If it's 20%, it's $6 billion. That was their intention. That was the statement put out on Saturday. Mexico did not put out an official statement, but instead, President Sheinbaum made some public statements limited to saying that her government is prepared and that it will ensure that Mexico is respected and that she might consider announcing specific measures on Monday. China made limited public statements, no official statement, other than they said, China firmly deplores and opposes this move and will take necessary countermeasures to defend its legitimate rights and interests. So, as I was putting this together last night on Sunday, one of my neighbors called and he was very worried because his phone was blowing up with news of the tariffs, and he's in the business of importation of doors and windows that go into big construction projects. And I said, well, first of all, the tariffs are not set to go into effect until Tuesday, Tariff Tuesday. That's number one. Number two, any one, two, or three of these countries, I would believe, would be on the phone with the White House saying and demonstrating the amount of law enforcement resources they are going to put towards this effort of stopping illegal drugs and stopping illegal immigration, particularly of dangerous criminal immigration. And if the countries show the White House that they're prepared to do that, my guess is the implementation of any tariffs would be delayed, if not completely eliminated. He's using this to sort of force them to use their law enforcement resources to benefit the United States. So I'm not worried. He said, well, look at the market, look at the futures. The futures are really, really going crazy here. And I said, okay, well, let's take a look at it. I'm going to move this into the screen. I don't do this too often. But this is the S&P 500, and you can see that's here's this big gap down. You see that big gap down? That was over the weekend. We were going to open lower, and then right around here, Claudia Sheinbaum, president of Mexico, said, "Well, I spoke to the president of the United States, and he's agreed to delay our tariff implementations by 30 days." In other words, she said, "Give me some time. Let me go crack some cartel heads and show you that we're serious about helping with the problem." And so just from there, we went from 59.23 on the S&P 500 all the way to 6,000. That's a pretty big move back up. We're still obviously below where we closed a little bit on Friday. The other thing that was happening, as you can see, now this is a busy and ugly chart, but the white line represents the U.S. dollar index, and the dollar, because the U.S. is a stronger player here, shot higher. The blue line is the peso. It's priced in dollars, so when it goes up, it means that the peso is going down. So you can see the peso, that's a big drop. Even though it's going up, that's a drop in the peso. Then she made her announcement, and the peso shot higher, wiped away all of its losses. All of its losses wiped out. Now, President also announced he spoke to Justin Trudeau of Canada today, and they are going to speak again in just a few hours. So I expect you will see similar, some kind of similar accommodation. And I still don't think any of these tariffs will be, on for a long time, if enacted at all. Many will not happen, but we will get help in law enforcement from our friends in Canada, Mexico, and in China. China may be the last one to fall, but they're likely to help out as well. So what is likely to, sort of come of all of this? As I mentioned, futures were down. They've recovered already very significantly. I do expect a relatively quick resolution that will include commitments from all three countries to aid the U.S. in these important matters. Okay, back to earnings. We've had about 178 of 500 names have reported. 138 of those beat expectations. Only 31 fail. The average earnings surprise is almost 6% above the estimates. Biggest gains, communications, financials, really crushing it. Technology not as strong as we would think. We had industrials down a little bit. 38 names have reported there. This week's economic data is plentiful. First week of a new month, so we get a lot of good stuff. We got S&P Global Manufacturing PMI and ISM Manufacturing PMI this morning. I saw S&P Global was above 50, meaning back into expansion for manufacturing in the U.S. in January. I haven't seen the ISM yet. Auto sales later today, construction spending, JOLTS or job openings tomorrow, factory orders, and then the two big jobs reports, both ADP as well as the Bureau of Labor Statistics, which will come out on Friday, both looking for about 150,000 jobs, looking for 4% unemployment. Michigan sentiment, I mentioned that early, consumer credit, just a big day, a big week. But all of this economic data will sort of take the back seat to this tariff situation. Yes, we have trade deficits with these countries. I believe there's a secondary objective there. But there's just a lot of oversimplification going on, right? If we slap a 10% tariff on something, does that make the price go up by 10%? Not necessarily. Some of it comes out of margin. If your dollar goes up and the other currency goes down, some of it is wiped out there. It's just a very complex, multivariable equation. And then the question is, well, what if the tariffs are only on for 3 days or 3 weeks or 3 months? It's really, at this point, this seems more like a tactical move within a broader strategic plan. Broader strategic plan is meant to halt, retard, stop importation of very dangerous and highly addictive drugs, as well as obviously the illegal immigration, particularly of the criminals, not just folks looking for a better life. Okay, thank you all. Thank you for tuning in. I will be back to you again in 1 week.